Joseph DeMatteo, Greg, thank you both for joining us today and continuing to talk about a very, very important subject matters inside of hospitality. As many of the people attending today are already aware, this is, one of the most interesting spaces in, commercial real estate. Joseph has a very extensive background, over 20 years. I'm not trying to date his age, but he's a seasoned professional. And, we're looking forward to hearing, from you today and learning more about where things are at and what the opportunity sets are. So thank you guys for coming back.
Thank you. Excellent. So I think that the key pieces that we want to definitely be able to hit on today is the lead in has to be the term du jour of everyone's concerns, which is inflation and how that's impacting what's happening. And what's, in regard to that concept of why we said next, innovation, implementation, and meaning is how everyone is trying to be able to figure out which way to go with this kind of factor, how it implicates necessity changes in hospitality and real estate in general. And I think that you've got to take us 2 steps back from the consumer to the kind of business side of where you look at things and say that you have a asset light and asset heavy structure that's happening. In a lot of major markets, you're seeing a shift from the individual consumer home person who's experiencing higher demand and therefore higher pricing for their individual homes in specific areas and states that are in high desire for people to be able to move to. And they are selling their homes and they're experiencing an initial increase of capital availability, but they're not able to buy back into their own existing communities. And then you have the asset heavy players, such as the big dollars, banks and institutions that are driving towards being able to acquire ready to develop sites at a very large premium, such as like Blackstone, that are hedge playing towards inflationary factors and dollar value of money, and trying to be able to get themselves out of cash and into hard assets as a hedge towards inflation and inflationary environment. So that's a key cornerstone of the why that we're seeing in regard to what's being driven by the restart of the economy in a post-pandemic time, and a cause that's really being driven by number one thing is wage inflation that we're seeing, which to a certain extent is a false positive towards inflationary times that we're seeing right now. The Federal Reserve agrees with that concept. That's why they're not necessarily moving as rapidly as they might need to in regard to interest rate increases. So that's changed a overall aspect and approach that you're seeing in regard to real estate. So you see acquisitions of big dollars and moving out of cash, and concerns that cash is going to be worth less, and the potential dollar devaluation is what inflationary is going to cause to concern, which everyone's not really necessarily terming it that, but that's really what it's going to change. Your dollar buying power is going to shift away. So considering that in real estate, the old saying that land, they're not making any more of it, the big dollars are trying to be able to move towards in incentivizing individuals to a certain extent to be able to cash out of homes that they may have even only bought 2-3 years ago in major markets. So how does that impact things? It's increasing the need and demand for rental housing. A lot of the things like Blackstone's strategy to be able to acquire and be one of the largest single home owners in the country and re-renting them back is where people are now who want to stay within markets is the only way that they can afford to. So selling their homes, making cash, and that cash is going to be becoming worth less there's no appreciation under what they're now being able to afford, but they're moving in and absorbing a tremendous amount of rental options that are out there. And the darling of real estate is usually the multifamily residential side, which kind of brings us to what's happening in regard to hospitality. And what we're seeing is, again, when a certain extent of false positive, that no one knows how it's going to move towards a more flattening of the yield curve, but a spike towards commodity pricing that are driven off of wages. And that wage false positive has been built off of a extended policy of unemployment factors that are where you see the net differential of people being able to, which I'm sure people have heard of already, they can, make the same amount of money sitting on a couch or going to work. And that, as that's starting to embolden and change, the jump start to the economy has created such a demand for employees and employment where those jobs are now having to be forced up in regard to starting wages and wage inflation. And wage inflation is a major issue for every hotelier because our operating businesses are built off of people, guests, relations, services that are provided, housekeeping, front desk services, marketing, food and beverage, and the supply chains that support those services are built upon the same thing, whether that's linens and cleaning, and as well as, whether it's from the guy who's delivering the frozen food to the people who are picking the vegetables that have to be able to be utilized from a food and beverage side. So this wage inflation factor is what's generating what I see to be a near-term false positive to the jumpstart of the economy. It's going to show, tremendous amount of increase over the next couple of quarters, but anticipate, that hopefully settling out as you start to see the global economy starting to connect, where you have, from the international side, from Europe and the UK, that they're behind our start. And I think that that's affected certain supply chains. I'm sure people have been even hearing that that there's a chicken wing shortage and certain things of that nature where you can't be able to access certain supplies. And that goes down the line from steel and lumber, everyone's paying attention to, that are needed. So how does that shift and change in regard to thinking and when it's going to happen? Well, it changes the entire underwriting process for today. It shows definitely the need for know-how. I think that it's showing the capability and the need for forward thinking in regard to either outsourcing some level of that risk by signing multiple year contracts, perhaps with taking parts of your operation and outsourcing it, whether that's a cleaning service that could be able to supply you with the manpower as needed, and when not needed, it's not there, and they have a larger in-market operation to be able to move and shift. There's a premium to that, but it does stop the need where you have the disruption to operation of that shifting and changing that you have to stop and recalibrate. We see that the next part of that in regard to these reflationary factors that are building into the commodity side, that it's going to affect underwriting for redevelopment of assets and development of assets. So you have a very keen concern of how do you underwrite to this? And then it goes back to, again, trying to be able to lock in, GMP pricing and within, a contractor's capability to be able to guarantee that project, and therefore be able to buy out the sub trades, which include, the materials, and they're going to get more savvy about it too. So it takes a very refined, capable, knowledgeable eye to the underwriting of what you're going to be dealing with the short-term capability of 18 to 24-month underwriting for any type of redevelopment or raw development assets of deals coming out of the ground. And the last point to that is the longer-term projects that I would deem to be 24, 36 months and beyond, that are having a heavy amount of pre-development risk, where zoning and so forth are at play. And I think that that's something where you're going to see a need and a demand for some municipal support to hopefully fast track some of these areas. So efficiencies can be able to be found in buying forward on your supply chains, trying to be able to outsource, and trying to be able to see what you could be able to do to effectively squeeze profit out of in a non-existent margin. We're seeing increases in occupancy across the general portfolio and market, but we still are seeing a price compression in ADR, especially in markets where there's hotels that are now opening, and now there's more of a flood of supply. So now you've got increases in supply matching some level of demand, but there's a pricing war that hasn't evened out between limited service, select service, and so to speak, luxury, because of the way that the openings have been occurring across the market. Not to mention new supply that was either stalled or not finished or at the the last phase of its repositioning to be able to be opened. And generally, those are the assets to be able to get market awareness are going to discount their accessibility. And there's a bit of a pricing war that I think that's happening and affecting, really margin squeezing. And that's lagging by three things. You've got the increase in travel. I think I've spoken before in the past regarding the concept of revenge travel, where people are just angry and they want to be able to get out and get around. And that revenge travel piece, so that's going to be able to continue to work along with tourism. The second piece is going to be a lag in group business that we generally are seeing is going to take some time, and maybe only 25 or 35% of that is kind of a return back to the marketplace. And then you have the larger business segment, which is, might look better in, 22 and 23, but in the short term is very, very difficult to underwrite and very difficult to be able to see where the bookings are. The forward booking window is not opened by much. It still seems to be very much a business of in the month for the month. And part of the ways that you could be able to innovate that is try to be able to, I just caution the risk in regard to some forward booking options that are normally out there in regard to working your travel channels and looking to try to be able to, the wholesalers want to be able to lock up shorter term, lower case rates today for the longer period of time. But the problem is that if you take those contracts today, you are also harming yourself because you're not seeing that wage increase. That's going to definitely probably be a larger sticking point in the next 24 months that we see as a problem. That you're having, whether it's cleaning crew, front desk crew, or management that is, so high in demand. There's a lot of moving pieces in monopolization of higher brand, more expensive brands that might be able to achieve some sort of rate impact that are paying up to be able to just get into operation. So they've already capitalized for that, but people who have been consistently in operation are dealing with those struggles. Greg, any questions yet? Or I know I'm hitting people with a lot of stuff.
So we've had federal response in the last 16, 18 months through PPP loans and various other assistance programs. What do you see? How do you see municipalities firing up their specific engines to get things going? What do you see that needs to be done to restart their economies?
So that's a great question. So you've had a geographic disbursement in the millions of people that have shifted and changed their life. You've got, New Yorkers that have gone to California, Californians that have gone to Texas, Californians that have gone to across the Southeast, and New Yorkers that have done the same tremendous amount of New Yorkers and South, I shouldn't just say New Yorkers, but Northeasterners that have come down to, the Southeast, especially Florida and Georgia. And what has happened in the federal response has been good in regard to the PPPs have been tremendous, especially in the hospitality industry. They've now done, it's exhausting itself in regard to the restaurant restart. And I think that's going to be some level of play, but though the parameters are so tight, I'm not sure how much of that's really going to get approved of what's been allocated. It doesn't help the pure hotel hospitality industry, though the PPP has. I think that they've slightly ignored the restaurants within hotels and the needs of those assets. I would like to see that there was some more federal support as a response to hard asset acquisition and financing of new equipment. That was something that was done in the early 2000s to kind of restart the economy at that time, and even in 08 and 09 a little bit, where, whether it's, the installation of new ovens, redevelopment of location, and spending money from that side. And I think that that's where the local municipalities should really try to be able to step up. The feds can support it from the side of having an accelerated depreciation valuation as a minimum side, and maybe local municipalities can, do something in regard to through financing and through either whether it's a tax deferral or reallocation of taxes to embolden those businesses to move and shake. I think that the Northeast and the Northwest had the greatest degree of concern of where they need to do a lot more. And those are going to be, repackaged tax incentives for the purposes of businesses either to newly establish, expand, or go back home. If you look at the deal that was done in Tennessee, it was the largest tax package deal ever done for a corporation. And that corporation was Oracle. And the reestablishment of a major office mixed-use development along the river there in Nashville. I think that that's a testament of how and what has been, the Southeast has been doing. I think the North has to kind of try to think along those same lines, and the Northeast and Northwest of where they need to kind of reestablish companies to want to be able to be re-incentivized. It's a counter and scary point that you look at what more, and it's more the impact than the politicization of it. But when you have a group like Morgan Stanley, who's using, I believe, the moment of vaccinations as leverage to de-office and decentralize, and now announced today, JP Morgan, the largest employer in New York City, who's saying, what should we do next? Whether you allow, people coming back to the office, and even clients coming to the office, to have some sort of evidence of full vaccination. And Morgan Stanley took the hardest approach of it so far. JP Morgan Chase is kind of like, what does the workforce think? And I think that was a interesting democratic way to be able to get a response back. But I think that they're angling towards, a deconstructed office environment that, people can sense that there's a much more permanency of it. And I think that that's going to impact the hospitality business from where you have full serviced, quasi, apartment rental, short-term rental to full service, select service hotels that can be able to take people for, a month or months at a time, for them to be able to live there and be able to deal with that. So I think that the municipalities need to be able to fast track, zoning responses and the ability for people to be able to access and get projects more fast-paced approved. I think that that's something that's within the control of the local municipalities to really do something that could be generating jobs in the local economy, creating new businesses and existing businesses to stay, and incentivizing other services that normally either moved away or can move back or expand back into those local areas. I think so. Zoning and approval process, you look at somewhere like New York City, to come out of the ground could take 6 to 8 years of forward thinking in a inflationary environment where, you have a potential that you're underwriting to a lumber cost and steel cost of today that could be, 30, 40% higher by the time you're coming out of the ground. It makes it very difficult. So I think they need to shorten that path. The second thing is, similar to what was done in New York City during the rebirth of Wall Street in the mid 90s, late 90s, of where they did apartment conversions from office and reestablish a new office space. And they were utilizing, tax incentives for both landlords and tenants, that they were able to use those incentives for them to repopulate and re-renovate older assets into repurposing them. And we're seeing more repurpose opportunities coming in the marketplace that require new innovation and new business thinking to be able to do that. So the municipalities now have to pick up kind of where the Fed started off, and whether the Fed is going to be able to, the federal government is going to be able to support those initiatives, is what may come out of the things that we'll see out of the infrastructure bill, which is stalled obviously at this moment, which is also stalling tax changes, which could be decimating to the Northeast and to the Northwest sides of our country. So we hope that those things get more trailblazed. We hope that there's a rethinking in regard to what they want to do for 1031 exchanges. Capping that out at $500,000 is a decimating factor to the what moves assets and money and new projects within the real estate industry. So you're going to have a stall out where people are not going to be moving towards cash holding for longer periods of time. And that's not going to cause a retraining and a rethinking for investors. They're going to now have to start really thinking much more long-term. I think the short term is the most unsure pieces, and you're going to need to take on more risk. I think that the traditional investor, because cash is going to be potentially devalued, if you will, because of the dollar impact of the impact of inflation on the dollar, that you're going to need to make decisions in a much longer period of time in that 6 to 10 year horizon as you're looking at things and underwriting them and investing in them. The short term is going to you need to take on more of that risk in regard to time. And when you look at projects and you see what's underlying it, it comes to time, money, and product. If people are looking to be able to generate yield in the near term, they're going to pay a significant price for those assets with a very low yield. And I think that that money is going in today because it's going to be going on low cap rates. You're not seeing that those yields change yet. There's no discount to product that we're seeing in the net lease world. If anything, we're starting to see prices increase and cap rates decrease for that general product mix for people they're trying to be able to move to. And people are not willing to move their money back out of the hard assets into more liquid cash because of the potential tax implications that are already being shopped, through Congress that are retroactive, that you can't plan for. So they'd rather hold on to the asset. So you do have a restriction in regard to supply, which brings the opportunity for new projects to come online. Any questions in queue so far? Anything from your side, Greg, or Michael, or Kevin?
Right now, I have nothing in questions.
So I've been either that boring or that complete in my thinking. So we'll continue a bit. And Greg, any questions that you have from anything I've talked about so far?
Sure. So with the mentality in the last 12 months of where, you know what, Joseph, we just got a question that just came in, so I want to honor that. Can you expand on the efficiencies of where you see opportunities and what has to be done to get to that level on the impact on earnings and margins?
So the efficiencies that have to be driven as a part of it has to be reviewing your existing technologies. So that's one thing that I think that everyone has to take a pause and a step onto and look at what the costs of those technologies are. There are things that are industry standards that are, if you have a portfolio of assets or a single asset, is what you need to kind of review. And I think that the technologies, because hospitality has such a complex, a hotel, to run a hotel, you could be running, different softwares for different things, from everything from marketing to operations. You can have, 39, 40 different pieces of software that are involved in regard to doing that. So you can streamline, eliminate, and also reduce expenses. Some of the industry standard ones that are out there are incredibly, incredibly expensive. And I would use Oracle and Opera as a standard. Their service charges are just, a wildcat to be able to control. They are, the Cadillac in regard to what it is, but do you need a Cadillac to run a 50 key hotel or even 150 key hotel? I think that the technologies have to be reviewed, what you're paying and expending on those technologies. And then what are you getting out of them? I think that people are so used to looking at it as a cookie cutter. Oh, we have, these 3 or 4 softwares that's just industry standard. Oh, it has to link to food and beverage. Well, how is your accounting department able to maybe create different controls? Is it that important for the guest experience that they have to be able to do a room charge? Or could you separate and reduce the costs by desegmenting your technology costs, using technology to increase efficiencies for housekeeping, and increase in regard to supply chain, food and beverage, and you can be able to utilize a better food and beverage service that doesn't give you the chargeback capability back to the room, but can actually watch market costs in regard to what is a tomato today and what's a tomato next week in regard to when you're doing your buying. And that is where you have to be able to use pennies and nickels to make dollars. So the first place I'd look for efficiencies are, number one, in regard to your technology, the existing costs of them, rebidding out your service providers, and lastly, what are you getting out of them in regard to how is it helping you manage that margin? So, with the time that we have, I think that I'll leave that one. Is there another question, Greg, that came in? I didn't see another one. Or
nope,
okay?
We're all set on that.
Anything else from your side, just as we wrap in the next 60 seconds?
So real quick, there's been a mentality of everyone's trying to get in on the distressed properties.
Sure.
And that's kind of like, it's become a false myth, so to speak.
Yeah, I think that there's a ton of guys that were waiting for the world to fall apart. I think that as the economy restarts and the PPP pieces burn out, and people are now dealing with these new wage changes, you're going to see an influx of bankruptcies. So the opportunities, I believe, are going to be more corporately than asset specific. Because I think that people still, what's saving the things are the fact that there's a flight to hard assets. So from a real estate perspective, those general bankruptcies might get saved in trade, but there will be more of a corporate dismantling that you're going to see, where the need for, let's say, REIT structured status for, let's say, whether it's an office REIT that's now has to generate earnings, and not just straight line their leases that have, dark space, where there's, a shadow market that's out there of vacancy that no one's really accounting for, because, the lights are on, but no one's home, is a standard in that market, in that world. So I think that you're going to find when have to readjust straight line rents because of either people terminating leases, walking away from leases because of corporate bankruptcies, or in refusing those leases, you're going to have that trickle down effect. I think first in the office side, most impactfully, before you see it in any other asset classes. The second will be anything that's kind of land banked at the moment, where there's a heavy redevelopment cost that's not been accounted for, budgeted for, or underwritten for. So I hope that helps.
Thank you very much. I think we're out of time. Mike,